Thanks, Lascan. And a few weeks ago, you might remember, I raised the issue of tax expenditures with Taoiseach Varadkar at Leaders' Questions. I put it to him that in all the 11 or 12 budgets introduced by Fianna Fáil and Fine Gael in the decade or more of austerity, they had contained finance bills with continually massive tax expenditures. I refer to briefing paper 13 of 2018 by our diligent and excellent Parliamentary Budget Office, which estimated basic tax expenditure costs at over $5 billion in 2016, rising from $4.7 billion in 2014. The Department of Finance, of course, only began reporting on these vast expenditures in 2014, and we received the Department's report for the 2017 expenditures on the day after the recent budget, rather than it being given to us into our hand, Minister, with the rest of the budget. And data on these expenditures, of course, is deficient, and many of them haven't been subjected to review for many years, despite the recommendations of the 2009 report of the Commission on Taxation. The scale of the expenditures is remarkable. For example, the R&D tax credit cost an estimated $670 million in 2016, CAT agricultural relief cost $141 million in 2017, and a range of reliefs supporting business cost nearly $560 million in 2015. Our Parliamentary Budget Office, of course, rightly declares that tax expenditures, and I quote, represent a departure from the equity principle of taxation and produce a fiscal illusory effect, end quote, when such expenditures are perceived as tax cuts when in actual fact they are spending increases. Surveying the finance bill before us today reminds me again, as has every finance bill I've studied in this House, the vast scope of tax expenditures provided for in the Taxes Consolidation Act 1997 and developed over the years down to this bill. The Minister, of course, will argue, and he did say something like this earlier on, Minister, your colleague Deputy Donoghue, that much of this finance bill is an attempt to close out tax loopholes and to strengthen anti-tax avoidance measures. But the sheer detail of Section 23 addressing tax relief for investment in corporate trades, and of Section 24, which includes amendments to tax relief for investment in films, and to Section 25, which implements Articles 7 and 8 of EU Directive 2016/1164 of 2016. It makes it very difficult, I think, for ordinary citizens to assess the net costs and benefits to the Exchequer. In other words, the whole presentation of the budget and the finance bill is something that has to be addressed in a much more transparent and open manner. The Minister, of course, did try to quantify income tax and some other changes on budget day, but what's your estimate, Minister, of the tax expenditures included in this finance bill, and indeed of the overall tax expenditures for 2017 and likely tax expenditures in 2018? I mean, I read the 2017 report, but it basically focused on a number of major expenditures rather than on an overall view of what current tax expenditures amount to. Over the past few weeks, the biggest anger, of course, directed at the government concerned Section 21, the amendment of Section 97 of the Principal Act on computational rules and allowable deduction. The section, of course, Lascan, permits residential landlords to deduct from their rental income 100% of the interest on a loan used to purchase, improve or repair rental residential properties. Up to this year, of course, the relief was capped at 85% of such interest, and Section 97(2)J allowed a loan interest cap of 90% for 2019 and 95% for 2020. But why on earth, Minister, was this change a priority for the Senior Minister and for the Government, given the continuing relentless rise in domestic household rents and the Government's ideological refusal, I believe, to address the fundamental issue of housing supply by state? I believe it should be driven by state and local authority, direct development and construction. The Residential Tenancies Board annual report of 2017 shows that almost 50,000 landlords control 2 or more tenancies, and this tax relief is squarely aimed at those hugely profitable businesses and not at the so-called accidental landlords, of which your colleague Minister Owen Murphy, he's always speaking lyrically about them. So will the Minister tell us the cost of this concession in tax expenditure terms, and will he further give the House an estimate of the total cost of Section 97(2)J of the Tax Consolidation Act 1997? This Section 21 is just another example of how Fine Gael and indeed Fianna Fáil remain completely enthralled, Lascan, to their big property and landlord backers, and indeed to the members of this House, who who are themselves landlords and therefore have a somewhat vested interest in this matter. Generally, of course, I welcome Section 22 of the bill, which at last begins the process of regulating short-term lettings. Many constituents believe that Airbnb lettings could not have been tax exempt under the Charlie McCreevy rent-a-room scheme, where the householder can now earn up to €14,000 per year tax-free renting out a room in their house. So the new 28-day rule provided for in Section 22, which amends Section 216A of the 97 Act, shows that the room must now be rented out for 28 days and expressly exclude short-term lettings from the initiative. And last month, of course, Airbnb reported that 640,000 guests use Airbnb in Ireland during the summer months of this summer, and it's been estimated that this and other regulatory measures will hopefully return at least 1,000 units to longer-term rental use. The changes to the universal social charge and standard rate and home carers credit in sections 3, 4 and 5 are also welcome, Minister, and I welcome them. In my own pre-budget submission to Minister Paschal Donoghue, which you might not have had a chance to look at, which we called a budget for all our people last can, I asked for an increase of €1,000 to 35,550 and 44,550 in the income tax standard rate bands, which was costed at 168 million in the first year and 195 million in full year. And I argued that it would alleviate current economic pressures on individuals and families who are generally hard-pressed to make ends meet. I want to thank, by the way, the Department of Finance and the Department of Public Expenditure and Reform for providing a facility for us in the opposition benches to try and cost some of the ideas that we had and some of the ideas that were coming forward, we thought, in the budget. That was very valuable, and we're grateful for that. I also believe that a modest increase in income tax credit, perhaps at a cost of 100 million, would have further encouraged hard-working citizens and their family. But given the serious risks Ireland faced in 2019, I thought a modest indexation of USC rate bands and exemption limits at a cost of perhaps 40 million might have been preferable to a further cut in rates as advocated by Fianna Fáil, and which is now before us. So I welcome sections 3 and 4, however, in that context. I note that in the budget estimated the USC tax cuts at a cost of 123 million in a full year, and the increase of €750 in the income tax standard rate band will cost, I think, 161 million in a full year. But Budget 2019 was generally very disappointing for citizens with disability. I think the 150 million or so you came forward with, Minister, it seems to have been basically addressing the demographics of our citizens, our citizens with disability, rather than introducing, for example, the cost of caring, which the informal, there's an informal Oireachtas committee on disability, which we advocated at a cost of €20 a week. All you did was, you've done, I think, this year, is set up a study that's costing 300,000 in relation to that. But I welcome the home care tax credit from 1,200 to 1,500. I also welcome sections 5 and 6 in relation to compensation payments for the victims of the Magdalene laundries and others, and also in relation to BIK relief for our defence forces in relation to accommodation and also medical treatment. But of course the Minister deliberately avoided increasing carbon taxes in Budget 2019, or even addressing the disparity between petrol and diesel fuel vehicles. Section 9 of the Act, of course, which you referred to earlier on, it does extend the exemption for electric vehicles down to the end of 2021, though it rightly applies a cap of €50,000 on that exemption. And Section 11, of course, amends Section 128F of the 1997 Act, which provides for favourable tax treatment of share options granted under the Key Employee Engagement Programme, KEEP. And we've heard a lot about that in the last year, I think, Minister, from your colleagues in the Business Department and from yourselves. But one of the questions I've asked Minister Donoghue for the Friday's finance questions is if he'll indicate how many companies and employees have actually availed of KEEP, of the Key Employee Engagement Programme, so far in 2018, and what impact he expects to result from his proposed changes, which are before us now for 2019. Media reports have called that programme, the KEEP programme, Minister, or Lascan, woefully unsuccessful, and there was an inference even, Minister, which maybe you could confirm, that not even one company had applied for this tax relief. And I think that Mr Donoghue, he did acknowledge the very low take-up during his own speech on a couple of Tuesdays ago on Budget Day, and he said he was going to take early action to address it. And of course, KEEP was introduced last year with the Finance Act 2017 and Section 128F of the Tax Consolidation Act 1997 provided that gains realised in the exercise of qualifying KEEP options by employees and directors won't be subject to income tax, USC or pay-related social insurance, where the requirement of Section 128F TCA 1997 are satisfied. However, capital gains tax is payable, I believe, on the disposal of the shares. So I note anyway in Section 11 before us, he's replacing the €250,000 limit in any 3 consecutive years of assessment with a lifetime limit of €300,000, and the limit of 50% of the annual emoluments in the year of assessment is now being increased by 100% of the annual emoluments. So it would be interesting to see how these changes, Minister, will actually pan out. I note also that from the 1st of January 2019, and also it's also obviously Section 56 of the bill, we have these significant new changes to the operation of PAYE, the modernisation programme, which has been undertaken by Revenue, and employers will need to calculate and report on the pay and deductions of their employees as they are being paid in kind of real time. And it's said that this modernisation will improve the transparency of the PAYE system and it's also its accuracy. It's suspected, I think, that approximately 200,000 employers will have to implement these changes, the biggest change, I understand, to reporting in almost 60 years. So, of course, the first deadline of 31st of October is just coming upon us, and there doesn't seem to have been, from some of the feedback we've got, that there's been sufficient communication and assistance to employers indeed in getting ready for these changes. So that's something perhaps the Minister might report to us again. Employers, of course, who haven't yet engaged with Revenue and who missed the first deadline of October 31 will be contacted by Revenue, but even then apparently the take-up has been very low. It's heartening, however, that the changes in Section 77 and Schedule 1 of the 2017 Finance Act will require employers to file a monthly USC return alongside the current requirement to file the income tax return. And of course, the additional superannuation contribution will also be payable by public servants starting on January 1st, 2019 under the Public Service Pay and Pensions Act. Last can, in my own pre-budget submission, I urged an increase in betting duty from 1 to 3%, which would have yielded €156 million in full year. I also believe that Ireland should have at last begun to equalise the levels of excise on petrol and diesel, and I note that even a modest 5 cents increase in diesel excise would have yielded €165 million in a full year. In the event, of course, Section 33 increased the betting duty to 2% for bookmakers and remote bookmakers, and I note the arrangements for the betting intermediaries, which the budget book's estimate, of course, will raise nearly €52 million. Section 35, of course, does introduce a 1% VRT surcharge for diesel engine passenger vehicles from January 1st next, and is estimated to raise €25 million on a full year. Based on the booming state of the hospitality industry, Minister, the Department of Finance assessment report, which we read carefully at the Budgetary Oversight Committee, and the strong arguments advanced by the Irish Congress of Trade Unions, I believe in my own pre-budget 2019 submission that the VAT rate should be generally increased to 11% or 11.5%, and that the latter rate would have raised an additional €289 million for the Exchequer. But since the Minister, I think, and the Fine Gael government were so adverse to any significant effort to broaden the tax base by requiring more tax contributions from the very highest paid cohorts, I recommended some changes for those earning over €120,000 and particularly those earning over €150,000, or to any initial steps to broaden carbon-related taxation. The Minister, of course, ultimately decided in one go to jump back to 13.5% for the hospitality and related businesses in the single budget, as we have here in Section 41 before us. Now, like other deputies, I've had serious complaints from small restaurants and hotels, hairdressers, other businesses, that given the anxieties about Brexit, in particular for tourism, that the Minister might have adopted a phased or a stepped approach to this change. I note and I welcome the 9% for newspapers and the new paragraph 7A which applies to electronic in Schedule 3 of the VAT Consolidation Act 2010, which applies to electronic publication. But what does the Minister estimate will be the net additional revenues for the Exchequer in 2019 arising from Section 41. I notice also that a colleague who was speaking earlier, he attributed the changes, I think, in Section 51 to the influence of Minister Ross. But we heard before the election, before the budget, we heard before the budget, in fact, that there was a lot of canvassing coming from Fine Gael, from your colleagues, Minister, in relation to Section 51, and that your Fine Gael party as a whole was very disappointed with the Minister's decision only to increase the capital acquisition tax Group A, the tax-free threshold, from 310,000 to 320,000. But many citizens, Lescan, will look at this finance bill and will continue to be seriously worried at Ireland's great dependence on corporation taxes from a small number of huge foreign multinationals. They are also deeply concerned at the strong perception that the tax avoidance industry will remain untroubled by this bill, and that Ireland continues to be referred to as a tax haven in international studies like those conducted by Oxfam and others. And while providing strong incentives, of course, for start-ups, Section 23 before us, and in fact Section 23, as you know, Minister, I think those three sections, is it 23 and 24, 25, they make up actually the bulk of the bill, in fact, before us. But it does seem to include a serious attempt by the Department of Finance and by Revenue to tighten up reliefs in schemes like the Employment Investment Incentive, the EII, and the SURE, the start of relief for entrepreneurs. I also note the anti-avoidance provisions, and there seems to be provision for clawback of incorrect self-certified returns, and EIE and SURE are extended, of course, to the end of 2021. But I mean, what are the latest estimates for tax expenditures under this section and the likely overall impact of these changes, including on promoting jobs, because at the end of the day that's what it all should be about, which make up a large part of that section in the bill. Film tax expenditures, of course, cost nearly 90 million in 2015, and I notice here we have the time-limited tapered the regional reliefs in Section 24, but again, how will they impact on tax expenditures? The other detail, of course, Section 25 refers to controlled foreign companies, and the Minister has said in his earlier speech that as part of our international obligations under the anti-tax evasion measures, we voted, of course, on the new anti-tax avoidance directive, the ARAD rules, on budget night, and the Dáil approved the 12.5% tax, and many of us supported that, Minister, because we thought that that's at least a start, and it's unrealised gains, of course, where companies migrate or transfer assets offshore. And perhaps the Minister will explain how the new broadly based exit tax improves on what he called the pre-existing focused anti-avoidance exit charge that he referred to earlier on tonight. So what's the exact difference resulting from this very long section? The controlled foreign company rules in the detailed Section 25, of course, inserts a new Part 35B into the Principal Act, but I notice that the new Chapter 3 that there are very significant exemptions applied to the application of this new exit tax, and perhaps the Minister will respond on the reasons behind such exemptions. The Minister said tonight earlier on that these measures in Section 25 fulfil our commitment, of course, under the corporation tax roadmap. But constituents will ask whether this section finally begins to address tax evasion structures, for example, like the single malt, Minister, and other devices to evade taxes in our jurisdiction. And that's again something that yourself and the Minister might come back to as the debate proceeds. We'll also be alarmed, many constituents, Minister, are also alarmed with the recent reports that we got from UNCTAD, the Conference on Trade and Development, showing that total foreign direct investment inflows to the state declined by €71 billion in the first half of 2018. And this clearly follows the so-called Trump tax reforms, and again highlights the failure of this government to broaden the Irish tax base. Minister, yourself and Minister Donoghue, you might have had an opportunity to read the report entitled, and I quote, Budget 2019, Issues for Members of the House of the Oireachtas, which was produced, I think, yesterday or the day before by the Parliamentary Budget Office. That report raises significant problems with the publication of the budget and of this finance bill. Besides the querying of whether the Minister has placed his total faith in an orderly Brexit and whether he is actually pursuing a counter-cyclical stance at all, the PBO raises important issues in the estimation of votes. In fact, can we believe the amounts that you've estimated for health or for justice, for example, and has requested major improvements in the accessibility, accuracy and consistency in the reporting of budget information. The Parliamentary Budget Office identifies a number of errors in the document entitled Budget 2019 Economic and Fiscal Outlook. And again, I wonder, is the Department aware of this and beginning to address it? And ask that this information, the corrected information, once amended, should be relayed before the Oireachtas notice. So that's a very serious charge, Minister, that there are inaccuracies in documents that were presented to us along with the budget. The PBO, of course, welcomes the announcement made in relation to green budgeting and also asks for much greater progress in relation to equality and gender budgeting. And we had a debate, of course, last week, on last Thursday night, on that particular matter. Really, some of the questions asked in that report, like, for example, the publication of a fully costed estimate for Brexit contingency measures, well, we still don't know. We're still nearly as vague as Theresa May's backbenchers as to what exactly will be the cost. I know you might say, well, she says the deal is 95% done, the divorce deal, but I mean, what kind of money are we talking about here? And why are the supplementary estimates included already in parts 1, 2 and 3 of the budget 2019 expenditure report? PBO raised the question of why should supplementary estimates which were not approved by this House be included in that report? And for example, why is the Christmas bonus again not included in the 2019 allocations? Why is that the case? Is that not misleading, Dáil Éireann? So I hope, Minister, that yourself and your colleague will respond to these criticisms, and you're also, of course, both very welcome to come before the Budgetary Oversight Committee at an early date to answer all the questions rightly raised by the PBO. So I think in the Finance Bill there are a number of welcome measures, but there are also huge lacunae and gaps, and particularly, as I mentioned, in relation to tax expenditures. I think the deputies and the House, we just do need to have much fuller information. We need all the figures so that we can properly conduct, I think, the finances of the nation. Thanks, Lascan.